Hello everyone, Chad Mace here with CEM Commercial interviewing Ryan, who is with one of our many capital sources. So Ryan, you specialize in stated income and stated asset programs. Are you able to do rooming houses, bed and breakfasts, and campgrounds?
Yes, actually those are all similarly tiered properties that we do work on. They're not as common, but the good news is because they're not very common, very few people lend on them. We do them. We do them very well. Bed and breakfasts are unique. Also properties where rooming board houses where everybody shares the facilities as far as restroom facilities and bathroom facilities, college towns, things like that. Yes, we do those. We do them very well.
Great. Do you only go by the debt service coverage ratio?
No, actually, if the property is income producing, we want to see that because that's very important as far as what the property is valued at in the commercial world. However, not every property is in a position to be judged on the debt service coverage ratio, or at least judged fairly. It comes back to our underwriting guidelines as being common sense. So in cases where we don't or cannot look at it from that perspective, we look at it from a sales approach. What are comparables for a similar type property either in the neighborhood or close by? Allows us to be able to do the financing for a borrower that borrower wouldn't be able to get financing elsewhere at a bank or hard money.
Okay. How high can you go with combined loan to values?
Well, if it's owner occupied, if the business owner actually runs their business out of the property, or if it's an apartment type complex area and they actually live there, 5 units or more, we can look at it as owner occupied and they can get 90% combined to loan to value.
Okay. And do you have any limitations on your cash outs?
As far as limitations for cash outs, we keep it relatively to what can the builder or business owner do to help improve their business. They might want to build, improve their property. They might want to do things like tax payoffs and pay off their back taxes. They might want to consolidate debts. They might want to hire somebody. They might want to buy inventory. So we can do all those for those reasons.
All right. In your introduction video, you mentioned something about permanent financing. What does that look like?
Well, it's just like I said, a lot of banks and other lending sources just lend on a balloon note, so they have to refinance in 3 years or 4 or 5 years. Hard money lenders, they want their money in 6 months to a year or two at a very high expense, where we will amortize over 15 to 30 years, and depending on the terms of the loan, it's either an adjustable rate mortgage or it will be fixed for 15, 20, 25, or 30 years.
Great. Thank you, Ryan.